Hello and welcome to Fidelity Connects. I'm Glenn Davidson. The world is arguably becoming a riskier place with weather events and natural catastrophes happening more frequently and more severe over time. How are insurance companies adapting to these changes? In real estate, the rental market faces challenges marked by oversupply and financial strains on developers, with winners and losers in this sector. How is this affecting market dynamics and investment opportunities? Joining us today to discuss evolving trends, challenges, and market dynamics in the insurance and real estate sectors, and break down the risks and opportunities in the months ahead is Equity Research Associate Connor MacGrath. Connor, great to have you here.
Good to be here. Thank you.
Connor, the last webcast you did, if I'm not mistaken, was back in January,
Yes.
and the wildfires in LA were happening at that moment.
Yes,
and
they
you
were.
talked a lot with Pamela about what you thought may be happening and the analysis that you were going to do through that whole event, if you will. Now we sit here in August. Tell us what's happened, what you've learned through it, and what's likely to be something we should keep an eye on going forward.
So I think the biggest takeaway is I think this is just another validation of I think what I've spoken about on a few past episodes around these large natural catastrophe events happening more frequently, but then also when they do happen, they're more severe, and the damage is more severe. And unfortunately, what we're seeing is a growing divide between the societal impact, the larger economic impact, but then also what insurance companies see. And a lot of that stems from the fact that there tends to be growing coverage gaps after these events happen. So the large event happens, an insurance company takes damage, their margins go down, but then they tend to pull back on coverage, which means that consumers are left without homeowners insurance coverage, or a business can't insure their factory or whatnot. And then when the next event happens, they're left in a bit of a tough spot, or they're having to look to more expensive insurance coverage options. And so what happens now is that, we continue to see more and more of these events happen. And so, 6 months ago, it was the LA fires. Now we're talking about wildfires in Canada, in cottage country here in Ontario. We had the floods in Texas. It's hurricane season right now in the Atlantic. And so there is that growing coverage gap, under coverage and under insurance. But then at the same time, these events are happening more frequently and with higher severity. And it's just a continuing problem that doesn't seem to be resolving itself at any point soon.
And I'm curious with what you saw in LA, can it be combined with what we've seen in Florida, where some insurers are just saying, we're not even going to provide coverage, or it's for an elite few. What are you seeing with that?
It's the exact same thing. It's the exact same pattern. Because unfortunately, at the end of the day, the insurance companies do have to earn an economic profit. They have shareholders that they are stewards of their capital. And unfortunately, it can be a combination of the fact that these events are becoming more severe, but then also there is a regulatory aspect to this as well. When you want to increase prices that you charge to homeowners, you have to usually get the regulator, maybe at a state level, to approve that. And at times there may not be proper approval, so you may not be able to earn a good enough economic return to justify you operating, let's say, in the California market. So your natural response is, well, I'm just going to operate to a lesser extent. I'm going to stop writing policies. I'm going to drop your coverage in that market. And that unfortunately leaves the consumer in a tough spot and creates, I think, a larger societal impact of people who, as I mentioned earlier, either have to access more expensive coverage or have to resort to options where they maybe don't get full coverage for the value of their home. And when the next event happens, it leaves them in a not so great situation.
Or they're relocating completely to a different state or different province,
Yep.
if we're talking about Canada, which is interesting that your responsibility is insurance and real estate. And actually, there's a real combination. We're talking about events in the US and Canada. Your focus is on Canadian companies, but you should be and are looking at what's going on in the US because it's really, there's a connection to all of that. So this has an effect on real estate as well, doesn't it? Where people will say, I just can't live in that state or province or what have you.
It's a real, and it plays into, I think it's obviously very well understood around, higher interest rates impacting affordability and whatnot, but I think there are also demographic and population movement changes within let's say the US, for example, where, it may be really expensive now to acquire homeowners insurance in Florida or in California. And so maybe I'm going to move more inland, let's say, or move to another state where there's a little less of risk of these events happening and damage happening in my home. But then also it is just maybe a little more affordable for me to actually live somewhere and not have to worry about, can I actually get adequate coverage in my home?
And that has massive trickle-down effects on builders, on malls, on recreation. That's actually, but that's a whole other story. Now, what do you do? Well, I've always been impressed with the access that equity analysts have at Fidelity to whatever it is that you need to do the right thing for the unit holder. With all that's been going on, how do you keep an eye on what's happening globally?
Yeah, it is a real advantage, being at Fidelity, because everything it feels like is a flight or a phone call away. And whether that's, my counterparts in London or other parts of the world that cover, US and European and Asian insurance companies, so I can understand what's going on in different parts of the globe. But then also I get access to experts. We can talk to a lot of the largest insurance companies in the world. But then you can also travel to where they do business. I was in Bermuda last December. It's where a lot of large reinsurance companies operate out of. And you really get access to how these companies think about these different problems that we just spoke about and how they tackle it, because you have to look at it from different perspectives and take into the fact that the insurers may look at it from one perspective. Investors in those companies, we have to look at it from another perspective, but then also look at the larger societal implications of some of these events that are happening. And at the same time, too, we get access to various forms of alternative data. It's hurricane season right now, so I use satellite data to track storms that are forming in the Pacific and Atlantic, try to understand their course trajectory, the strength of the storm, and you can analyze certain things around like wind shears and moisture levels in the atmosphere, ocean temperatures, things like that. And I think, again, it really speaks to the strength of the research platform that we have, that I have access to this. And I'm able to kind of help our portfolio managers make very informed decisions around some of the companies that we invest in based on a lot of this work and a lot of this data that I have access to.
It must be fascinating for you to have a keen eye on what's happening with the tumultuous weather, et cetera. And when you were in university, you probably never thought you'd be monitoring weather, but it's impactful to what it is that you do.
Yeah.
You mentioned the conference for reinsurers that you went to visit all of them, typically domiciled in Bermuda.
Yeah.
How do they factor into this? Maybe a reminder for me and for our viewers, how does a reinsurer work? And are they potentially cutting off insurers who are then cutting off the consumer?
Yeah, it's a great question. So to put it very simply, reinsurers exist as insurance for insurance companies. They are essentially a way for insurance companies to protect against tail risks. So think very large events, a 1 in 100-year event, a 1 in 1,000-year event, where an insurance company at the end of the day is very focused on protecting the capital on its balance sheet. That's paramount. And there's different ways to do that, but one of the easiest ways to do that is purchasing reinsurance and kind of additional coverage where, if a loss comes in and it exceeds a certain threshold, then the reinsurer takes a piece of that. And as you mentioned, yes, reinsurers do play a very important role in the whole value chain of offering insurance to an end consumer like yourself, let's say, because at the end of the day, if I'm an insurance company, I can't get access to some of that tail risk protection, then I'm going to maybe reduce my risk appetite and write less business, let's say maybe in a higher risk market like California. And that has a trickle-down effect on the end consumer, because then they have less available options to purchase insurance at the end of the day. And so there really is an end-to-end impact that you see that flows through the whole value chain, especially when some of these large events like the LA fires or hurricanes do happen. And you may not think about, the trickle-down effects through the value chain, but they are very real. And from my perspective, I can see the full end-to-end impact of that play out.
A comment I have with auto insurance, and I'm going to relate it to home insurance.
Sure.
I think people sometimes think the auto insurance is based on what I've paid for a car. I bought a Honda Civic, it shouldn't be much. And then they get the bill, and it's huge because of the probability of problems, because there's so many that are out on the road. Is that happening with houses more so?
Yes, and it's interesting you bring that up, because when I talk to some of the insurance companies I cover, they give some really interesting examples of ways that they use AI, ways that they use machine learning, and all the different data points that they get to, as you mentioned, become a lot more segmented in how they ascribe a certain amount of risk to maybe your house and maybe the one right down the street. And they may factor in things like the slope of the road that you live on, the grade, soil quality. They may also look at past events in your claims history versus their claims history. They may look at past precipitation levels in that certain part of the city that you may live in. And they all factor that into, hey, Glenn may have to pay a slightly higher premium than someone a few doors down, mainly just because of factors X, Y, Z that we're able to put into our model, and it spits out a bit of a higher risk profile, let's say, for your home versus someone else's.
That makes sense.
And they can adjust pricing, and they can adjust the way that they segment that based on those factors. And it is really interesting. And again, technologies like AI and whatnot do enhance their ability to make those kinds of decisions. And at the end of the day, they're trying to get the best outcome for you, obviously, but they also are trying to get the best outcome for shareholders like ourselves if we invest in them as well.
Hello investors, we'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
How do you use AI in what you do every day?
I use AI, I guess, to probably speed up certain workflows. So whether it's going through conference call transcripts or summarizing long forms of text or whatnot. I think I've maybe been a slower adopter of AI maybe than some people on our team that are maybe a bit more front-footed there. But I think it does have its use cases though. Just, you think about our job as analysts, there's a lot of information coming at us in a given day. We get hundreds of emails, there's a lot of research reports and things like that you can read. And so if there are ways to automate or speed up some of those workflows, make it a little easier for us to synthesize information, pull out kind of key takeaways and summaries and whatnot. I think those are some examples of what's happening, but I think I may be on the slower end of adoption maybe versus some others on my team, but hopefully I can, kind of recalibrate that a little bit moving forward.
Not the slow end, you're just being cautious. You're doing your due diligence.
Perhaps, yeah.
What's great though is that you have access to it.
Yeah.
And where you see you need it, you'll be able to utilize AI appropriately. And you've got examples around you. So that's a good thing to know.
Exactly.
Interest rates have a bearing on the balance sheets for insurance companies.
Yes.
Talk about that and where we're standing right now.
Sure. So very simplistically, insurance companies make money in two ways. So you make your underwriting profit, so your premiums minus the claims you pay out, and that's your underwriting profit. But then the second piece, and Warren Buffett talks about this, the float of an insurance company. You pay your premium up front. You take that and you invest it mostly in bonds, corporate bonds, government bonds, any kind of fixed income instrument, and you earn interest income on that. And so that makes the second component of earnings. And so generally, higher interest rates are good for these companies. It means that their earnings go up, they earn higher yields and whatnot. And so we have seen an interesting interest rate dynamic now where the Bank of Canada has made several rate cuts over the last year or so. There seems to be some probability of the Federal Reserve starting to cut rates later this year. But at the same time, though, we have seen a bit of stability in interest rates on certain parts of the curve. Just I think people are still trying to figure out longer-term inflation expectations just around the way that the economy is growing, tariffs, and things like that. But generally, though, higher interest rates are good for my insurance companies that I cover. Lower interest rates are maybe a little less advantageous for them in terms of earnings power and returns on capital.
And can you talk about the overall vibe of insurance companies in Canada, kind of the macro on that from an investment standpoint?
Sure, yeah. I'd say it's, even through, the tariff landscape, we've seen, pretty stable employment levels in the US, maybe a bit of a tick up in Canada. You have to sort of think of some of these companies as a little less macro sensitive at least on the property and casualty side, because at the end of the day, what tends to drive a lot of their pricing and premium growth is driven by inflation. They have inflation in the underlying claims that they pay out, and so they have to price adequately for that. And so a lot of their growth is going to be driven more based on those factors than others. And in certain parts of the economy that they play in, inflation is running a lot hotter than you would see in the headline CPI numbers that we see every month. And so they have to make sure that they're adequately priced for that. And then you layer on additional risk factors like storms and frequency and intensity of those as well. That's another consideration too. But generally right now, though, they have been trudging along quite well. And then, higher interest rates have been beneficial to earnings power for these companies over the last few years. And so they are earning, higher returns on capital. And that is, has been good for these companies, has allowed them to perform quite well on a relative basis versus the TSX over the last few years.
Well, interest rates also connect us to real estate.
Yes,
and that's your other portfolio.
That
So
is.
let's move to real estate.
Sure.
And perhaps we'll talk about residential purchasers versus commercial first.
Sure.
Interest rates. Yeah. Where's the buyer at these days?
It's funny because it's, you would think with, the amount of interest rate cuts we've had from the Bank of Canada so far that you'd see some kind of rebound or a bit of recovery. We haven't quite seen that, it feels like. And, the a lot of my companies, I cover apartment landlords for reference, and so there is some direct competition with them versus the condo market in Canada, and that's a market that has been in quite a tough situation for the last few years, right? You had a lot of condo supply being built during COVID. We exited COVID, interest rates went up, and so right as a lot of these condos were being delivered and finished, you have a very high interest rate backdrop and not quite a very robust demand backdrop for buying these apartments or these condos.
Mm-hmm.
And so what you're seeing is a lot of these condos are now coming into the rental market. The owners need some form of cash flow. They're willing to just rent them out, maybe at a discounted price versus a traditional apartment. And that's creating oversupply issues within the broader rental market. And I think to a much more tougher degree than what we've seen in past cycles,
Mm-hmm.
unfortunately. And so the data I track does show that apartment rents across most major Canadian cities peaked in about fall of 2023, and they've continued to come down year over year since then. And a lot of that has been due to some of these oversupply dynamics that we've been seeing, both in the condo market, but then there also has been some in the traditional rental market as well.
And from a rental standpoint or ownership, when it comes to condos, we're seeing massive buildings come along as well, which is probably builders getting over their skis, developers getting over their skis. One Bloor West is an example. I see that a lot coming downtown. I think it's 85 or 90 stories, but they've had issues with who's going to be the retailer on the main floor. That's changed. They've had issues with what five-star hotel is going to come in. They've had issues with bankruptcy. I believe Tridel, who's running it now, is saying we're actually going to subdivide more units so that we can get lower rents for people and get more people in here. Are we going to see this more often? Because I hear about more and more of these massive buildings being proposed.
Yeah, and you've seen examples, I think, of some of these smaller developers, maybe a little less well capitalized, starting to struggle or projects go under. In terms of the larger developers, I think a lot of them, I think right now are still in an okay spot. The thing is, well, you sort of have to remember is a lot of these projects have a certain percentage of their condo units that are already pre-sold. And so the risk then is kind of more on the buyer not being able to close on that unit when it eventually becomes available and finished, and then they have to, get financing to buy that unit. And is the unit still worth what they originally paid for it a few years ago? And so right now what we've seen is stable, maybe slightly higher, I guess you would call it default rates on some of those pre-sold condos not quite closing yet, but we haven't seen anything dramatic to kind of cause major alarm in the market. But at the same time, though, it's the strength of the buyer is still not super robust, and there isn't a big appetite from incremental buyers to step into the market quite right now.
I want to pick up on new buyers. You are by far much closer to graduation than I am. What is happening with new grads as far as interest in buying versus doing just other things with their income?
I think it's interesting. I think and you sort of see this across broader parts of the economy. I think you think about household formation, I think has been pushed out almost a few years versus maybe pre-COVID. I think you've also seen people allocate income maybe more towards experiential activities like vacations, things like that, maybe versus more materialistic purchases and goods and whatnot. And so I think that, is an example of some maybe demographic shifts that are kind of going on in terms of buying behavior and whatnot. But then there also is the broader interest rate sensitivity that is also going on. Interest rates are higher than they were, before COVID and during COVID, and that does have an impact on, people's propensity to, be willing to make a large down payment and commit to a mortgage or whatnot for that. But at least within my generation, though, those are sort of some of the things I'm noticing.
That makes sense.
And I think that, my hypothesis is that could, potentially be playing into some of the behavior you're seeing.
So to sum up what you just said, what looks better on Instagram, a trip or a mortgage paper?
I guess so.
Why don't we shift to commercial now? We'll talk about Boston. You and I have both been down to Boston to see Fidelity's head office many times. It seems there's a shift down there to the Seaport area versus the Back Bay area and the core. In Toronto, we're seeing more of a shift towards Lakeshore, where the big bank buildings have gone up. And I'm sure that's the same in many other cities across the country. What's that all about?
So I think what you're seeing, and this ties in really well actually with the office market, which is an area I spend a lot of time looking at, and companies I cover play in there. And so what you're really seeing is a big bifurcation, I think, between, call it like the old city and the new city, I guess is maybe the best way to kind of characterize the dynamic you're talking about. And I think what you're seeing is a real bifurcation between these flashy new office buildings the new bank buildings, let's say, that companies want to be in there. They have really good amenities. They're right by the lake. They're right on major transit lines. They have good restaurants in the ground floor, let's say. They have access to the path. And you're seeing companies shift from some of these older, maybe more legacy buildings. They're maybe not quite as kept up and whatnot, and they're now looking to move to an upgrade to something a bit more robust. And I think part of it too is I think their employees want that, and I think they're listening to what their employees want, especially coming out of COVID. And so unfortunately, what you're seeing is some of these older buildings being a bit left behind. And so I think the risk is that over time, a lot of those buildings continue to be left behind. The winners kind of keep winning. And there's risk, potentially that some of these buildings become obsolete over time and maybe need to be repurposed into something that has a higher and better use, perhaps. And so, Boston, I think, is a good example, and other cities as well, that have kind of followed that similar trend. But you are seeing signs of that, though, in Toronto.
And so then you've got premium locations and then more mid-tier locations. You mentioned about maybe a redevelopment or a repurposing. Is that what we're going to see? Maybe a conversion to condos? I guess it all depends on what are the bones like of the building? What are the ceiling heights like? What's the HVAC? Everything else. It's really, there's a gutting that needs to happen, a huge cost.
It's just as much of an engineering problem, as you mentioned, as it is a financial problem. You need obviously the money and these are expensive. They're not cheap to fully repurpose a building into something much more than it was. But again, you have seen examples of these office conversions that have happened. Boston is actually a great example where there's certain tax incentives that the city may offer to developers to incentivize this. We've seen this happen a few times in Ottawa and in Calgary in Canada. And even in Toronto, there's examples of companies that I cover and have come across that have existing office buildings or assets that they're looking to repurpose into more of a residential use case. But it is quite the engineering endeavor. You have to figure out, is the floor plate, conducive enough to, sustain a residential condo. There's considerations around elevator shafts, HVAC, lighting, even like the window setup on the exterior of the building and everything like that. And so, we haven't seen anything immediate, but I wouldn't necessarily be surprised if you see more of that start to happen over time as some of this potentially obsolete buildings or these legacy buildings start to be repurposed into something that the owner can get more economic value out of.
In most large cities across the country, there's a classic building right in the middle of town. And it used to have a sign on it that said the Bay. What do you think is going to happen there?
I hope that they stay there. I'm a fan of some of the legacy architecture in the city. I think it adds character to the city and kind of keeps us grounded in our roots and whatnot. But I hope that it continues to maintain some of that character while also being able to serve a better purpose, for the local economy and whatnot. And so hopefully over time you can maybe have a combination of some of that legacy architecture and kind of some of the ground floors, and you're able to build up from there. But I hope they never go away.
Preserve the historical aspect.
Yes,
that
exactly.
would be beautiful.
Yeah.
Now, what's happening with return to the office? Because that's something else. Companies have signed up for large floor plates and numbers of them. They may change that. That changes rents as well. Can you monitor? Is there a way that you can see how many people are coming to the office and what's happening in that respect?
Yeah, I actually can. So when you come into the office, you have your badge, you swipe your badge, you tap it, it lets you into the building. So that is data that we can see in terms of total cities in downtown Toronto, New York, Calgary, whatnot, and you can aggregate that and see how many people are coming into the office every day.
You have access to how many people are coming into a particular company that's unrelated to the company that you work for, but not by person. You get an aggregate.
Not necessarily by company. It's more aggregate by downtown Toronto. But yes, I can see kind of average utilization in a given day of the week versus pre-COVID. Let's say that's usually the best benchmark to kind of compare to. And what you're seeing is, utilization levels broadly are still below where they were pre-COVID, but we have been slowly grinding higher as, you see in the news around return to office mandates. A lot of this, again, is somewhat company specific, but I think, you are starting to see a bit of a broader trend of people being in the office more frequently. And again, that I think also plays into what I was speaking about earlier around the bifurcation of, companies wanting higher quality space. If they want their employees coming back, they want them in the best office space. They want them to have the best amenities. They want them to be close to the subway line or the Union Station, let's say, in Toronto. And so that, I think, all sort of plays into what we're seeing right now.
Transit is a touchy subject in Toronto,
yes.
so we won't go there.
Yeah.
Earnings overall, earnings season's wrapped.
Yeah.
What was your vibe for, let's talk about insurance and then real estate.
Sure. I'd say the vibe was okay. I'd say overall, a lot of the trends I spoke about earlier for both, I think, have definitely continued to play out in the actual fundamentals. It's not just narrative. You actually, I can see it in the numbers. But in general, I'd say things are continuing to track along with kind of what we've been seeing in the broader economy. You've seen companies on average start beating earnings across Canada and in the U.S. And again, there's a lot of company-specific factors and industry-specific factors that are going on. But you're still seeing the same things. You're still seeing office occupancy continuing to grind higher. You're seeing continued softness in the rental market in Canada. And at the same time, you are starting, continuing to see some of this weather-related volatility, some of the insurance companies I cover, but there is obviously still that underlying inflationary component that they have to be cognizant of as well.
Makes sense.
Yeah.
I just want to pick up on something we discussed earlier in this webcast, which is the access that you have. You cover Canadian insurers, Canadian real estate companies, but it's imperative that you understand what's happening south of the border and all around the world. And you're constantly doing that. Through electronic means on your desk, but through visits that you can make, companies that you can see anywhere you need to, conferences that you can attend, and colleagues around the world that you can talk to. Can you touch on that resource and what it means to you?
Yeah, I think when I first came into Fidelity, I had heard about all of these resources that I had at my disposal, but then it's one thing to hear about it and another to actually live it and see it. And it's quite, I feel quite privileged to be in this position where I'm able to have the access that you just spoke about. Because at the end of the day, I think it does speak to our ability as active managers to add value to clients, to be able to have access to these resources, not just in Canada or in the US or our local market, but just globally. And we're able to leverage a lot of those insights across the globe to make better decisions at the end of the day for clients. And I think it does give us a real competitive advantage, I think, versus some of our competitors. But at the same time, though, it does enhance greatly my research process, and I think the research process of the other analysts and portfolio managers on the team. Because at the end of the day, I think it's been our bread and butter historically has been able to leverage this access. And I only see that as something that continues to strengthen over time.
Good stuff. You're certainly not in a silo, which would be to the detriment of the investment process. If I'm not mistaken, you're 3-ish years into real estate and insurance sector.
Correct. Yeah.
And my understanding is that an investment analyst at Fidelity cycles through a number of different sectors in order to get great exposure and great understanding, great learning, so they can become a diversified portfolio manager.
That's right.
Where are you at with that?
So I am I'm about at 3 years actually on my
You're right there.
coverage.
Okay.
Yeah. So I'm actually currently in the transition process onto a new coverage package, and so I'm kind of pulling double duty right now, if you will. But as you mentioned, though, there is a very well-defined process of how we go through these rotations, and so as I'm rotating onto a new coverage, it's not like I'm leaving all my old stuff on its own and leaving portfolio managers hanging out to dry or anything like that. There's, there is a replacement, actually 2 replacements I have, one for insurance and one for real estate, who are subsequently picking up coverage of my existing companies. I'm sort of helping.
They replaced you with 2 people.
Essentially, yeah. But they're, I'm helping them transition along the way. They're adding unique insights to portfolio managers as they're new to the space and whatnot. And as that's going on, I'm rolling on to a new space, learning all about that. And it's quite an interesting experience because, it's really right as you get very comfortable and very knowledgeable about the space. That's exactly when you rotate. So, but that's exactly what's happening though internally. But it is a very well-defined process though, and there is a real method to the madness that you see.
Makes a lot of sense, and I hope to be here someday with you talking about whatever the new sector is that you're responsible for. But on insurance and on real estate, you were very informative today. And thank you so much for your time.
Appreciate it. Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.